Australia. If you do want to explore working with us, then the next step to do that is to book a strategy call with one of our accounting team and to just see if we're a right fit and to discuss what what you're looking for in an accountant. And if we're a good fit, we can chat through what the next steps are for that. Now, the other thing as well, so towards the end of last year, I published my next book, which was It's All Sorted. It's a business owner's 9-step guide to master your tax and achieve your peace of mind. If you do want a copy of that one, there's a QR code on the screen, or there might be, thanks, Tay. There's a link in the chat box that might be helpful if you do want to explore that. I run through things like the tax rhythms that small business owners face, different structures that might be available to you, and discussions around the pros and cons of each, and then plenty of content there on tax saving strategy, which is the key or one of our biggest focuses at Inspire. Just also an intro to me. So I started Inspire when I was 23 years old. I'm an award-winning chartered accountant with over 17 years experience. Written those 2 books, Wealth for Life and It's All Sorted. And there's a couple of photos of my lovely family, although it doesn't include our newest edition, child number 4, born about 5.5 weeks ago. So that's baby Vera. Also, a bit of an intro to Nick. So Nick is a certified financial planner and the director of Millennia. He assists clients with wealth accumulation, retirement planning, and self-managed super fund. He's a huge sports fan, ranging from golf to rugby, including American football and basketball. And again, thanks, Nick, for giving up your time to share with our audience on how they can build wealth in our current trading conditions.
Welcome. Thank you for having me today.
Yeah, cool. Well, what I might do is just run through some high-level topics, and then I'll hand over to you, Nick, to present. And then in terms of the audience who are along, feel free to pop questions in the chat box as we go, and we'll either run through the questions if they're related to what we're talking about at the time, or we've got a section at the end for Q&A as well. But broadly, the 5 topics we'll cover is asset allocation and its impact on long-term investment returns, how to navigate investing in varying economic climates, the role of diversification in a well-constructed investment portfolio, human bias, I think this will be a big thing personally, when facing investment decisions, and the active versus passive debate and the difficulty faced when trying to beat the market. Awesome. Well, thanks again, Nick. I'll hand over to you, just give me that nod on the slide when you need it.
Okay, I will do. Let's jump to the first one, which has got a lot of weird and wonderful numbers on it, which may look a little overwhelming to some. But in essence, I think today, wanting to keep things as kind of surface level as I can, whilst I guess reiterating some pretty important points and what I feel probably moves the needle most when it comes to investing. Quite often I find that when clients are faced with investment decisions, there's so much noise at the moment, and with social media, news at our fingertips, live investment markets, it makes it very hard to decipher what's actually real and what's important. There tends to be a lot of focus on the micro, and I guess the things that won't really move the needle to a great degree. And we sort of tend to throw the macros out, which are going to make the biggest impact on your long-term wealth creation. So hopefully today, I can give you some examples and try not to get into the weeds too much with technical terms, but I guess really have that takeaway point of the importance of actually just getting started, not worrying too much about, the second decimals, focusing on the big items and trying to, I guess, remove some of the human bias out of the investment decision-making process, which, really in essence will be the biggest factor as to whether you do it, in fact, successfully reach your goals. So, wanting to start off initially just with discussion around asset allocation, which then will lead us into diversification, where we see current markets, and then I guess, just touching on a few other bits and pieces, mostly relating to, again, that human bias, human behavior, and psychology around money generally and investing. So the first slide that we've got up here really, again, just reiterates the asset allocation piece. So what we have here essentially is 30 years of publicly available information from Vanguard. So this pertains to listed investments and varying different asset classes. Ultimately, for myself and my team at Millennia, and it's the same tack that I've taken over the preceding 15 years, is that the underlying asset allocation is going to be the primary driver of return within your portfolio. Quite often we do get caught up in the minutia of stock selection. However, when it's all said and done, the underlying asset class, all things being equal, is really what's going to be the primary driver of that return outcome. Now, it's funny because it's typically the opposite of what you might hear in the media. In essence, they're always going to try and sell you the next best thing or the next best stock pick. And funnily enough, that's not really what will move the needle to the greatest degree. It's actually just about getting the understanding of fundamentals around what am I wanting to invest in, what is my objective, and then what corresponding asset allocation do I need to achieve that objective. Really the active nature of stock picking, it does in fact fail for the most part. There's many people around the world that have made businesses out of it, and some of the most talented minds in the world can beat the market from time to time. However, the majority of these same talented people actually fail pretty significantly on a year-to-year basis. So we'll approach that at the later point in today's webinar. But as you can see here through the numbers, ultimately the diversification is paramount, and the asset allocation, will vary greatly from year to year. So, this here just shows us how difficult it really is to pick the right winner each year. It's like going to the racetrack on a weekend. So, as you can see, it's very rare. It's almost, non-existent to actually see the same asset class be the best performer year in, year out from a back-to-back period point in time. So, the caveat to that is we may actually see it this year with US stocks. Obviously, US shares had a great year last year. Year to date, they're also having a great year. A lot of that is based on the composition of US investment markets, the big rally we've had on the back of AI and tech, which, the NASDAQ especially is very heavily exposed to, the S&P 500 to an extent as well. So, we may have US 2023 and 2024 as being the best performing asset, but, conversely, we only have to look at some of the, geopolitics around the world. We've got to look at the upcoming election in the US, even the events that happened last weekend in the US as well. We could have US being the best performing stock market. We could also have it being the worst performing stock market, depending what happens now and over the course of the next 5.5 months. So we could quite, it could in fact be that cash or government bonds is the best performer this year. We just don't know. And to be frank, most people don't know. Many people will sit there and tell you that they know, and they make a career out of doing that. But ultimately, none of us have the crystal ball, and we can't accurately predict the answer to what will be, the best asset allocation or the best performing asset class in a year. You go and ask 10 different economists, you'll get 10 different answers, because ultimately it is fortune telling. And if you want to jump to the next slide for me, Ben, we'll actually see what the flow on is from those different assets over the long term. So as we can see here, again, this encapsulates a 30-year period. So, it's very easy to focus and cherry pick data over a short amount of time, whether that be 12 months, 24, 3 years, 5 years. This is pretty compelling data because it does in fact cover 30 years of data. So, as we can see there, the best performing asset class over the last 30 years up to 30 June last year was US listed shares that was providing a return of 10% per annum. and as you can see on the corresponding right-hand side there, you're going to have different fluctuations. Obviously, US shares, the 10-year return has been 16.5. So it's had a very good decade. Aussie shares coming in second, international shares third, which is obviously all shares ex North America. And then, ultimately, it will just show us that sticking to a long-term investment plan with that diversification across asset classes, it in essence just allows our clients to grow their wealth over time. So it does, even though it seems very overwhelming, it actually becomes a somewhat simplistic endeavor to orchestrate an investment return based on what it is we're looking to achieve, because really what we're doing is looking at those varying asset classes, blending them together to get the desired risk metrics, the desired outcomes from a return point of view for our clients. So, even in the face of market crisis, short-term volatility, we can see that these long-term investment returns do in fact prevail. And individual investors are rewarded for staying the course with a corresponding risk preference and risk profile. And as we can see here, the traditionally safer, more defensive assets, which are your cash, term deposits, bonds, as expected, they come in as the lower performing asset classes. And, inevitably, this is to be expected. It all comes back to that risk versus reward nature investing. And there is definitely a place in portfolios for those assets. They provide a good ballast against volatility. We want to pick things that are negatively correlated to one another. We don't want everything going up at once. We don't want everything falling at once. So each of these different asset classes do in fact have a place in a well-diversified portfolio. And I just think sometimes it's important to really just move the noise away and focus on history, which really is the best proxy we have for how things may look and feel moving forward. I've heard for the last 15 years that the data that we see here, it's not going to repeat itself. However, that same rhetoric just has been said time and time again. And here we are 15 years down the line. And as we've seen so many times before, the reward is there when you're taking on risk, by virtue of Australian shares, international shares. And, ultimately, as I said, that's the best proxy for the where to from here. And I guess that's the best reference point that we have to really work out what is going to be the most effective and proficient portfolio for you. Everyone's going to be different. Some people are happy just putting everything in US shares. And as you can see there, you're going to get a 10% return based on, historical returns. And then quite often we have clients that may only need or want a 3 or 5% return. So we're trying to go and achieve that for them in the most risk-adjusted manner, which means that we've got the luxury of taking on much less risk to achieve their desired net objectives. So that's kind of, where we get to from an asset allocation point of view, which for me is really going to be the primary force of moving forward, getting the return that you're looking for, because we can't sit there and want and hope to get an annualized return of 8, 9, 10% while sitting in cash and term deposits. As we can see there, it's not a viable proposition. But then conversely, with the higher growth assets comes some additional volatility. So we can't then, sit there and be solely invested in Australian shares and international shares and expect them to carry the same level of risk that cash, term deposits, and bonds will carry. So, it's that simple discussion of you can't have your cake and eat it too. So, if you jump to the next slide, Ben, I might just I'm sure this is on everyone's mind at the moment. We hear a lot about where are we now? What's the market doing? We're in a pretty dislocated time, just given how volatile things are. I guess, this is our 1 or 2 slides on a page of where we think things are currently. And again, these things can change day to day, week to week, just depending on what's happening out there in the wider marketplace. But look, I mean, ultimately, especially outside of Australia, the narrative is that the soft landing remains the base case. Inflation, which has obviously peaked on the back of COVID, is just gradually returning back to government target. Robust earnings growth supporting market valuations as well, which is why equities have had a good rally. Especially over in the US on the back of a heavily tech-oriented index, and the Australian market has hit record high as well. So we've had some good growth there as well. We expect probably close to 1.5% of rate cuts over the next 2 years for most markets. So, being Australia, New Zealand, and Canada, UK. Same with the US. Obviously, we think the US is likely going to cut much earlier than Australia, just based on recent data. And we still think that there's going to be some reasonable returns for shares on offer. So, look, we are modestly defensive across our portfolios. And it's interesting because most people would think that that's because we're concerned about the share market and what the outlook is there. But it's actually because of the strong returns on offer across the defensive asset classes. So, cash, we're getting, north of 5% in short-term term deposits, and we're getting high yields on treasuries, credit, corporate bonds. So, ultimately we're being paid to wait there, and it's a very different environment if you've got a portfolio where you're seeking to achieve a 6 or 7% return, and you can make up 5 or 6% of that from defensive assets. So it just means that we've got the luxury of having a different portfolio composition compared to where we might have been 2 years ago, where the Aussie cash rate was down at 0.1 as opposed to 4.35 where we are today. And when you're getting, lackluster 1.5% in a term deposit, and you want a portfolio return of 7, in essence, it just means it's a job that much harder to achieve, because we're then forced, ultimately to jump into more risky assets. So if you jump to the next slide, Ben, that's sort of reflected as well of our current positioning with regard to our bond exposure, where we're sitting with cash, which, as I said, that's a very valid option, just given that we're getting some generous returns on offer to hold and wait. We do like to put cash to work when we feel that it's a viable time to do so. Might not be a popular view, but we're heavily underweight Aussie shares, and we'll touch on that in the next couple of slides, and sort of some rhetoric and rationale as to why that is the case. Still overweight international equities to make up for that shortfall in Australian growth assets.
Sorry, just to interrupt, I've just seen a couple of things in the chat. Are the slides showing okay? You can see the slides? No, Olivia's saying no. Let me try this again. Someone's saying yes. All right, there's lots of yeses. That should be back on now, yeah? All right. Awesome. All right, thank you. Sorry, Nick.
Okay, that's okay. No problem at all. I guess, a lot of this is just based on our fundamental views of where things are within the marketplace. And I think it's important to note that a lot of what we do and where we feel the long-term benefits of portfolio management come from are that asset allocation. So when we're seeing the different changes within the wider economic landscape and investment markets, it's not a catalyst for us to, in essence, go down to the nth degree of stock selection. But a lot of these things will temper and change our view on the overarching asset allocation within a risk profile. So hence why we may be underweight Australian shares, overweight international shares. And that can change on a dime just based on, economic data that's coming out where we feel there's, a better opportunity set. Because ultimately our job for clients is to, I think most importantly, keep them out of harm's way, which fundamentally a lot of the time is stopping them from purchasing things when they shouldn't, and stopping them from selling things when it's probably not the best time to do so. but it's about that voice of reason as to this is what we're doing, this is why we're doing it, and this is how we feel it will best benefit your portfolio from a net perspective. Obviously it's such a changing time at the moment with the inflationary pressures, with some of the political tensions around the world. We've still got some interesting things happening in Europe with regard to manufacturing and industrial performance, as well as the ongoing war over there. Lots happening in the US with regard to upcoming election, and just even some different policy over there as well. And then obviously our domestic market, which is inevitably always plagued by the elephant in the room, which is housing. So we've trimmed our Aussie exposure as a result of that. We're sticking close to our strategic asset allocations because we do think there's pretty compelling reasons on both sides of the coin to be both bullish and bearish. So look, at this point in time, we do prefer value versus growth stocks, and some greater international exposure versus domestic. And just because of the run that we've had in some of those larger cap shares, especially on the S&P 500, and because there is that light at the end of the tunnel with regard to rates coming down, we are starting to have a bit of a rotation toward some more smaller markets, small cap versus the traditional large cap markets of the likes of S&P 500 and the top 50 in the ASX. But look, I think it's so easy to get caught up in the noise of everything that's going on, and that will always be the case. If it's not what we're facing today, it's Euro debt crisis or Brexit or COVID or GFC and all the different events that are inevitably always going to rear their head on the investment journey. I think it's important that that we do take a step back and realize that investing is complex. The most important attribute that we try and push to clients is that we need to stick to an asset allocation that they're comfortable with, that's going to achieve their objectives that they're wanting to reach, and just continuing to invest at all stages in market cycles, because it's very easy to listen to the naysayers, which is typically the media, and I know justify why it's not a good time to invest. We've had a lot of client conversations over the last 18 months where that's been the sort of general narrative, and we've stayed the course, and clients have been rewarded handsomely for partaking within investment markets over the last 18 months. So I think it is important to make sure that we focus on that. And if Ben wants to jump to the next slide, we do just touch again on that the importance of portfolio diversification. So, this ties in very well to the second slide, which, as you can see there, the best performing portfolio is a portfolio that's solely in shares or stocks. So Australian shares, international shares, and we can see that obviously the end result there is a far greater return on investment than solely a more defensive portfolio comprised of bonds. But where we get to in the middle there is what you've probably heard from before, which is the balanced portfolio. And that's typically a portfolio that makes up 60% of stocks and 40% of bonds. You will inevitably give up some upside in potential return, but what it does allow you to do is greatly smooth out the volatility of return. And the reason why that occurs is it's because we look at the correlation of assets together. And again, the only time you want positively correlated assets is when things are going up. But again, unfortunately, we can't hold things that only correlate the right way in a good market and go the opposite way in a falling market. So, if we have a little look there, back in 2008, which we'll all remember was a pretty big event, being the GFC, we can see there that shares just took an absolute nosedive to the extent of, close to 55% over sort of an 18-month period. But then, of course, at the same time, we can actually see that the class of bonds, being the defensive assets, went up over that period. So that's where we talk about negative correlation, where shares went down, bonds went up. The overall 60-40 portfolio did go down, but obviously to a far lesser extent than the bloodbath that would have occurred if you were sitting solely in shares. And again, over the long term, had you just sat there 100% in shares, it would have been the better performing asset. But I've seen it time and time again that people just don't have the stomach for that journey. And by having something like a more balanced portfolio, it does allow you to stay invested in the game for a longer period to reap some of those longer term rewards. So I think it is important to note why it is just so relevant to have some diversification across your portfolio, not only in asset classes or across asset classes, but also in asset classes as well. And the next slide just reiterates that same point again, where we can see conceptually that the annualized return over this 20-year period that is plotted here gave more or less a 3% return on bonds and an 8.2% return on stocks. When we blend the two together, we get a 6.5% return, which is very respectable. The annualized risk falls through the floor, and as does the Sharpe ratio, which essentially measures the performance of the investment compared to a risk-free asset after adjusting for its risk. So, we want that to be as high as possible because it just means we're getting, sort of the best bang for buck with regard to risk versus reward. There might be some of you sitting there now that have experienced your portfolio falling in certain periods and not being negatively correlated, even though you may hold bonds. And there are periods where bonds and stocks don't negative correlate to one another. So we've actually seen that in recent time. Over the last sort of 12, 18 months, we've actually seen them being positively correlated. So when shares have fallen, bonds have actually fallen as well. And look, they will typically act as an efficient portfolio hedge. We've had a bit of that dislocation recently with just out of the ordinary inflation. If we go back to the 40s, we can see that bonds have in fact hedged stocks whenever inflation is under that 4% mark. Obviously in recent time, we've really fallen outside that band, which has, made it a bit of a different consideration. So we still feel that there is some good value there in government bonds and the like. And again, just goes back to that rationale and reason why you would have some diversification across your portfolio. If Ben jumps to the next slide, it's again, I put this one in there just to sort of put an exclamation point on this. Obviously, we've seen it, slide number 1. I think it's important just to raise it again because it does, again, just show the importance of spreading out your assets. They will perform differently year to year. We don't know what they're going to do this year or next year. Nobody does. So if we can have a little bit in each camp across the different asset classes, it's just going to put us in good stead moving forward. And now if we jump to slide number 8, this is probably a little favorite of mine. Goes back to, I guess, human psychology and the inevitable bias when investing. So quite often we have clients that come in and they'll have a portfolio of shares. That portfolio of shares, could be by way of an index fund, an ETF, or, it could be direct shareholdings. But one takeaway that I see very often is that a large chunk of their share exposure is in the Australian market. And it is an interesting one because obviously the size of Australia and our annual GDP is actually less than 2% of the entire world. So it's interesting when clients come in and they hold anywhere between 50 and 100% of their portfolio in Australian shares for their growth exposure. Obviously there is some benefit from a taxation point of view with dividends and franking credits. But all things being equal, we do find historically that a balanced portfolio between Aussie shares and international will provide a better return and also, a smoother ride. But I think it's important to look at the Aussie market as a bit of an outlier. Just inherently how concentrated and how shallow the market is. And this slide that we've got up here, in essence, it just shows us that close to 50% of the entire Australian share market is made up of 10 holdings. So, the next slide we jump to again just shows that those, some of the names in those 10 holdings contribute to this significantly, but more than half of our market is just solely financials and materials. So, think financials being the big four banks, think materials being the likes of, your BHP, your Rio Tinto. In essence, the reality is that the Aussie market just doesn't offer what other countries do, particularly the US, especially when it comes to technology, healthcare, and industrials. So, we're dominated by traditional companies such as ANZ, BHP, Woolies, where, we've got a lot of other exposures across the US, Europe, Asia, where companies are offering, a lot more innovation in tech, AI, medical science. And I guess that's why we've just seen such a big run in the NASDAQ, especially to a lesser extent, the S&P in the US. And a lot of that is based on that tech sector, which we just don't have the exposure to over here. I mean, in the Aussie market, ultimately we've got tech, which makes up, it falls actually under other, which is the 4.3% of the Aussie market. So that's why we've been a bit of a laggard comparative to the US especially. And, moving forward, that's why we have trimmed our exposure and we're underweight. So if Ben jumps to the next slide, it will probably answer some of those inevitable questions around why we are in fact underweight within Australian shares. And a lot of that, again, just feeds into the fact that over half of our market is materials and banks. So this slide here gives us some context around the materials conversation. So, ultimately we're pretty bearish on iron ore. And a lot of that is due to China's economic rebalancing toward domestic demand. So we can see on the left-hand side there that, they're ramping up their domestic production, but then also demographics in China. So, if we look on the right-hand side there at the birth rate over in China to date, but then also forecasted, we can just see that that's fallen through the floor. And that is going to have an inevitable impact on, the amount of steel demand for office and residential construction, which, ultimately that negatively impacts our exporting across to that market. So we are somewhat concerned about the materials exposure within the ASX 200. And then the next one, which, is our probably greater concern, is Aussie household debt, which, inevitably feeds into that 30% financials exposure on the ASX. So, it probably doesn't come as a surprise, but, the household debt levels in Australia at the moment, they're just past points that we haven't, that have been problematic in the past. So, we're worried about potential default risks, especially if inflation's not curbed and interest rates don't come down. Again, different challenges for our market comparative to some of our international counterparts. So, in Australia, you're probably lucky to get a 3 or 4 year fixed mortgage. Over in the US, they're all predominantly 30-year fixed. So there's less of an impact on spiking interest rates, because a lot of people are still fixed in at 30-year rates with a 2 or 3 in front of them, where obviously the Australian market is so indebted from a housing point of view, but obviously so heavily reliant on variable rates comparative to fixed. So those are the concerns we harbour in the Australian side. Look, we still obviously have a decent exposure to Australia. In our holdings, we still think it's a viable place to hold money. It's just about potentially being selective with how much you're putting into that space. And yeah, the next slide, the takeaway from that is, again, just reiterating that there is just such a human bias and human psychology component when it comes to investing. We can see here that the ASX investor study found that 50% of Australian investors held shares on the ASX, but only 16% held international shares. And that number becomes even higher again when looking at self-managed superannuation funds. So 73% of funds within the self-managed space had Australian shares directly, only 23% held international shares. So, that's that home country bias. It's not just unique to us. US investors are heavily in US stocks, but we just need to be more mindful of it over here, given that nature of how shallow our market is, how concentrated it is at the top end, and how small we really are comparative to some of our global competitors as well. The last one, which is also another fun one, a lot of people will try and argue this one till the cows come home, but ultimately it goes back to that debate of active management. So, individual stock picking, individual active asset managers versus, the things that you'll hear around in the media around ETFs, index funds, Vanguard, BlackRock, passive investments. So I'm pretty passionate about this one because, obviously active management carries with it a much heftier price tag. And a lot of the time we're seeing client portfolios that come to us where they're paying for the privilege of active management and they're underperforming the cheaper passive counterparts. So, it's interesting to see here that, the percentage of stocks that actually outperform the index at the moment, typically it runs at about 50-50. So to be on the right side of the equation, it means that you need to hold the winners and not hold the losers. Otherwise, you get the benchmark. Now, at the moment, that's just gone further and further again. So ultimately, to beat the market at the moment, you need to own the 30% of stocks that have outperformed the market and not own the 70% that haven't. So really, if you look at the odds of winning, they're just not there. It's like going to the blackjack table and having a 30% chance of winning and a 70% chance of losing. It's probably not a bet that you're going to take on. Typically that's closer to a 50-50. But, there's always a number there that means the house wins. So you're still willing to take that on when it's near on 50-50. But, at the moment with the composition of the market, especially the likes of, AI, the Magnificent Seven over in the US, means the other 493 stocks in the S&P 500, they're not doing as well. The top seven are carrying the can for the rest. So really, it just makes it that much harder to actually sit there and to not only pick the winners and not the losers, but to have a meaningful amount in the winners to really beat the market there. So, we've seen that time and time again in different markets and over the years. And, this somewhat pertains to individual investors that try and sit there to pick the individual stocks, but it actually also relates to professional investment managers that have a basket of different investments and they're trying to beat their underlying benchmark. So the next and final slide that Ben can jump to is the percentage of large cap domestic equity funds. So this is over in the US that underperform the benchmark every year. So, as we can see here, first half last year, 60% underperformed the benchmark. We go to 2021, 85% underperformed. So again, if we're doing it solely on a risk-adjusted basis and we look at the numbers there, on average, more than half of the managers that are active are underperforming the benchmark, which is, their passive competitors. So, as the problem is as well, and the numbers only get more confronting as time periods grow larger. So, ultimately for us, that's why we typically use anywhere between 40% as high as 70% of our portfolios as passive vehicles to get the bulk of our asset class exposure. When we have a constructive view on an asset class, we will just often go overweight within that from an asset allocation point of view. But then we do use active managers to leave the door open on different things. So, there may be a passive index that we don't like in a developed market space because of some of the shares that fall into that category. Different geographies and different sectors that we may look at may lend themselves towards some active management because we feel that they can fundamentally and in an easier manner outperform a passive investment. But for the most part, if it's and this is just general advice. It's not specific to your circumstance, but for the people playing around at home, I guess my main takeaways when it comes to investing is, first and foremost, really understanding what your objective is. What is it that you're wanting to achieve? And, if you were to fast forward 10, 20, 30 years, what objective is it that you had hoped that you will achieve on your investment? And then, from there, if the number's 7%, it's then working out, based on a 7% return, are you happy with the level of risk or volatility that you need to take on to get that? Once you've then really, I guess, answered those questions, it's just about, going and finding what is going to tick those boxes. So for the most part, I mean, you've even got probably, arguably the most successful investor of all time, Warren Buffett, saying that, if he was advising people, 99% of people should just go and put their money into a passive or an index fund. And I'd obviously, heavily agree with that as well. And my other piece of advice is to never look at it again until you actually need the money. So don't listen to the media, don't listen to the noise. There's always going to be a reason why you shouldn't invest. The earlier that you start, the more compounding that you'll get over time. The less likely you are to, be in a situation where you're taking money out when it's down in value. And, ultimately, when you've got that volatility in the market, it's actually friendly for you from an ongoing investment point of view because you're just continuing to buy assets at a cheaper rate. If you only invest once and you never invest again, obviously we only ever want to see a straight line. But if you're investing on an ongoing basis, which only helps to minimize risk, some of that volatility is actually going to be beneficial for you long term. So, look, I think some of the premise around investing is pretty simple. We tend to find that a lot of it, what we do is coaching people, keeping them accountable, staying the course. And I break it down to our clients as, it's like personal training. I mean, we all know what we should be doing if we go to the gym. We all know what we should be eating if we want to lose some weight. But a lot of the time, it's we know how to do it, but we need to be kept accountable to do it. And it's very much the same with investing because, but what's between the ears tends to get involved, and yeah, we derail ourselves, and we're our own greatest enemies. So hopefully, some of that information's of benefit, and I can try and talk you away from getting caught up in the bright, shiny objects and just sticking to some of the fundamentals, which over the long term are probably going to put you in the best position from an investment standpoint.
Wonderful. All righty. Well, thanks so much, Nick, for that. That's a lot of awesome tips, and especially just to balance out all the craziness we hear on the telly or on the scroll. So I guess, we've got some time for Q&A. So if anyone has a question, please pop that in the chat box. And while you do that, feel free to follow Inspire or Millennia on the various social media channels. And we will also have a recording of this webinar if you sort of joined late or want to send it to a friend to rewatch that. All righty. Well, thank you everyone for joining. And again, just keeping an eye on the old Q&A box. What have we got? No questions so far, eh? It was comprehensive.
Information overload.
That's it. Any thoughts or comments? If no one's got a question. What I found interesting was that graph, personally on the, active versus passive and the ability to pick stocks. I didn't think it was going to be that different, but putting in perspective where to outperform, you've got to pick the best 30 and not pick the crappiest 70. That's let's just go to the blackjack table.
Yeah, look, I mean, it's a marketer's dream to sit there and say that, you can do the stock picking. But again, it's just been shown time and time again that there's so few that, manage to do it. But for the most part, they fail miserably. So especially in some of those more developed markets, and when we're dealing with larger cap stocks, and obviously one of those markets is the S&P. And I think I just saw a question from one of the guests, from Jolene, is the S&P 500 US only? It is. So that's essentially a basket of 500 US companies, similar to the ASX 200, which is a basket of 200 Australian companies. So, it's probably their primary focus from a share market perspective. I mean, the Nasdaq's a pretty large market over there now as well, just due to the tech composition. But it's, when you go and invest in the S&P 500, a lot of those companies may be domiciled in the US, but they do have pretty significant operations outside of America. So it does actually help you get diversity of income stream. And when we are investing internationally, there are other considerations such as foreign exchange. And just depending on where currency is, we can always look to either take advantage of what we think the Aussie dollar will do comparative to where we're investing, or we can just take a neutral position, which means let's say if you were just doing an index fund, you might do 50% in, unhedged international shares and 50% in hedged, which means that in essence, you're net neutral against currency movement. But otherwise, you can then start playing around in the foreign exchange game, which, it seems easier than what it is. So then, quite often it just comes back down to what you're wanting to do there.
I think we've had another couple of questions. We've got how come there is less and less companies paying dividends? Rather focusing on the share price. Should a good business practice pay dividends back to investors as a good business practice to reward the risk that investors take? That's from Olivia.
That's a good question. So, dividend policy is interesting because it tends to be quite sticky. So once it gets set, the companies are hesitant to pull it back down. Paying a large dividend quite often can actually be somewhat of a troubling sign for a company because they've got excess capital and they're not reinvesting it back in the business for future opportunities. So I actually had a conversation with a gentleman recently, and they have one of Australia's largest privately owned companies, and his commentary to me was that they typically reinvest about 70% of their profit each year back into the business. And when it came to shareholder conversations, his comment to me was that we pay shareholders what they need, not what they want. So, sometimes an excess dividend can be great because it's a sign that, a business is doing really well and, they've had excess profit. Other times it can be that it's a warning sign because, they may be in a contraction period. They're not using it for R&D or expansion or different investments within the business. So it very much just comes back to the underlying business at the time, where it is in the cycle, and in essence, what's happening there.
All right, and another dividend-related question. Olivia's got a few here. What's your point of view in dividend investing?
Yeah. I mean, look, for me, I think it's great to reinvest dividends or distributions, because again, what that's doing is just redeploying capital back into assets that you have conviction in because you're holding them in the first place. And it means that we're just buying more units in those investments. But it comes down to very much individual preference, because there may in fact be a need for income to survive, for example. So we'd prefer clients to use the dividend income for their day-to-day living expenses rather than, being forced to sell down shares that, potentially are in a capital gain position. It becomes sort of agnostic if they're sitting in a tax-free investment environment such as a superannuation pension. But for a lot of investors, if they actually need that cash flow to live, that's a better strategy rather than having to sell down the share itself. If it is surplus to your needs, I'm a big fan for investing back those dividends back into the underlying investment or company. But if you had concerns about the company you're invested in and you're looking to divest anyway, you probably don't want to go and double down back into it. But if you do have some conviction, there, I mean, ultimately, there's nothing wrong with redeploying that capital back into the same shares that you're already holding.
Apologies, Nick. Just had to duck out for a sec. Did you see that one on share buybacks?
Let me have a look.
Yeah. So, what about share buybacks? What's your thoughts on that one?
Yeah, I mean, look, again, comes down to the rationale as to why. It can just be excess capital. They want to take some control back without really delving into balance sheet items and I guess more macros around what the business is doing and what the rationale would be behind the share buyback. It makes it hard to know because, again, that can either be a good sign and it can potentially be a bad sign. It really just comes down to drilling down to that intricate level of the individual company. And, I guess for individual investors, they're only really, they are only privy to public information. If they're privy to private information, then obviously, that's insider trading and we don't want, people to be delving into that. But if you're only privy to public information similar to everyone else, it makes it very hard to get an edge on any news that comes out because that's typically already factored into the share price. I think for the mum and dad investor that don't have the time to sit there and pore over, yearly financials and AGM minutes and the like from companies and know what's happening in that sector, that's why it just makes so much sense to get that diversification across different assets, which is exactly what an index or passive investment will do. So if you put $1 into the S&P 500, that dollar will be spread out across the 500 companies based on their weighting within the S&P 500. So you kind of get the best of both worlds there, and you don't have to go down, really trying to scramble around and find intricate detail about each company that you're investing in.
Beautiful. All righty. Well, I can't see any more questions that have come through just yet. Oh, hang on, one more. Oh, yeah, another one from Olivier. All righty. What are your thoughts on equal weighted index?
I do like it. I have used it for quite some time, both in Australia and also on the S&P. So there's some good products out there that are passive that allow you to do that. So I guess a simplistic way to look at it is, if you went into the ASX 200 and you put $100 in, obviously, 200 companies, equal weighted, each company gets 50 cents of your $100. So that's how equal weighting works. If you just go into the ASX 200, you put $100 in, $10 is going to be HP instead of 50 cents. Depends on the market composition and how it performs. The index is typically relatively self-selecting. So if there's a company not performing, they're pushed out of the ASX 200 or the S&P 500, and they're replaced by someone that, quite rightfully should probably be there. It's just when we've got severe dislocations, like say, for example, now where we've got, the Magnificent Seven over in the US. So the likes of, NVIDIA and Microsoft, Apple and the like. If if you're bullish on those companies, it would make sense to just go into a normal S&P 500 index. If you're not wanting such heavy exposure to those shares because they are big weightings, you can go into something like an equal weighted index where you're still getting exposure to them, but on much lesser extent. So it is good from a risk mitigation point of view. Obviously, it's a guessing game. If those 7 stocks keep performing, you miss out. If those 7 stocks underperform and the other 493 outperform, well, you're going to benefit. So, it's a bit of a gamble. And yeah, it's a more intricate strategy. But again, I think I'd prefer to see someone with exposure to an equal weighted index internationally and domestically than just having a handful of, your typical ANZ, BHP, CBA, Rio Tinto direct shares in Australia.
Awesome. No, I didn't even know what that was, but it makes sense just to avoid that. Getting those big ones in the majority of your holdings, but no, very good. All righty. Well, we might wrap up the webinar there, and just another big thank you to you, Nick, for joining on the webinar and sharing with our community. We'll be able to share contact information with anyone who registers after today, and for anyone who did register, there will be a link to the recording as well, just as a reminder. But thanks again, mate. Really appreciate it.
Welcome. Hopefully that's helpful, and hopefully I can convince you to put money into some good quality investments and don't listen to the noise and just keep doing it for a long time.
Beautiful. All righty. Thanks again.
Thank you.
We are the Sultans.